Okay, let's talk about a good defense for defense stocks.
There are very few companies that are going to hold up in this period. I'm using a 1990 metaphor, so to speak, which was the most stress I've ever seen in the system other than 1987 and the terrible Tuesday in 1998. But this one seems much more like 1990 because then it was a question of the banking system, and that's what it is again. I think that what you should be looking at when you are buying a stock here is that you say, is the client solvent and can the client spend as much money as possible? I have gravitated toward the defense stocks because here the client is the U.S. government or the Middle East in terms of the Saudi Arabians or the Egyptians or Israel, which have guarantees of United States protection. And that means that Raytheon, Lockheed Martin, General Dynamics, Alliant Tech, the bullet maker, could really be look, there's no such thing as a safe place in this. I know that there was an article in this morning's journal about how diversification hasn't helped you, and I thought that was really a shame because then it might convince people that diversification isn't worth it. There are times in your trading life and in your investing life where you're going to take a beating. What you really want to do is take a beating less than the other guy. And the way to do that is to be diversified. And what I've been recognizing is that a diversified portfolio of a healthcare cost containment company, a drug company, a food and beverage company, a defense contractor, and until today, an oil company, I still believe in oil, might be a better way to go. If you don't like oil, then I think infrastructure. If you don't like infrastructure, then I would put an agricultural company in there, which are all doing good. Now, one of the things that people have to recognize is that there's a lot of weak holders in stocks. So even if you may have a strong company and a strong client base in the company, the actual holders of stocks are in very bad shape here. I think a lot of people were margin. By the way, if you're margin, you really got to get off margin because I think you will be wiped out in this decline. That's how I see it in all the other declines. But diversification still works. It just, what it does is it keeps you in the game. It allows you to have sustainable losses rather than unsustainable losses. Well, does that mean people should just go into cash? I think if you haven't raised a lot of cash, it's still not a bad thing. We had an oversold bounce last week on Wednesday and Thursday. We should be due for another oversold bounce this week. Maybe we get some action from the Fed that's not that bad. But on any strength, as opposed to now when when the old days when you would buy weakness, I think now on any strength you should lighten up. And it wouldn't be bad. I was telling contributor Bob Morrison from realmoney.com that I would probably be running my hedge fund 50% long, 20% short, and 30% cash. 20% short because we've come down a lot and because I sense that there's a big short base, a lot of people shorting. 50% because I actually have stocks that I like very much and I've been buying for actionlaunchplus.com because I'm taking a very long-term view. And then 30% cash because I truly believe that the opportunities will come. We're minus 7% on the proprietary S&P oscillator. We've come down a great deal. There are many things that look attractive to me, but you have to buy them in stages. You can't commit all at one level.
Okay, diversified, keep yourself in the game. Jim Cramer, Brittany Umar, Wall Street Confidential.